Good morning, everyone. Afternoon, evening for those joining us outside of the Bay Area. My name is Adam Sterling. I'm an associate dean at Stanford Law School, and we're pleased to welcome you to another edition of our new webinar series that's part of Directors College program. We're working with our affiliates to touch the hottest topics impacting boards and corporate governance. Today, we're pleased to welcome two guests from Sullivan Cromwell for a conversation on shareholder activism. Our guests today are Lawrence Elbaum and Patrick Gadson. Lawrence and Patrick are the co-heads of Sullivan Cromwell's shareholder activism practice and partners in the firm's M&A group. As mentioned, this program is part of our Directors College event. The 31st Directors College at Stanford University will be June 22nd through 24th at Stanford. We'll put information about that in the chat. We'll also put information for those seeking CLE to register in the chat, so pay attention to that. Again, just a pleasure to welcome Lawrence and Patrick, who are at the forefront of sort of seeing and understanding what's happening in the shareholder activism space. They have some slides, but we also want to make this an interactive conversation. So we'll be monitoring the Q&A throughout the presentation. So definitely use that. On your toolbar, there's a Q&A button, and so we ask that you submit any questions or comments that way, and I'll work with Lawrence and Patrick to address those. So Lawrence and Patrick, thank you for joining us, and I'll turn it over to you.
Thank you. Oh, I see a message popped up already. Thank you for the very warm introduction. It's wonderful to be here. Lawrence Elbaum, partner at S&C in the M&A group and co-head of the activism defense practice here. This is all that Patrick and I have been doing for the past decade. That's defending public companies and their boards against what continues to be a rising tide of shareholder activism. During that period of time, we've defended over 400 campaigns together. We're going to cover several topics today, and we do hope that we get interrupted with questions, although feel free to save them for the end if you wish. But we're happy to undergo cross-examination throughout. In terms of the agenda for today, we're going to cover what's happened thus far, actually through about 3.5 quarters of the 2025 proxy season from the perspective of shareholder activism campaigns. We'll go over the different methods and technological advances that we're seeing from activism campaigns in the market. And we'll talk about the legal and regulatory landscape as well. We'll also talk a bit about what we see heading into next proxy season, the 2026 proxy season. And then we got a number of slides with thoughts on advanced preparation, because a well-prepared board can never be too prepared, in our opinion. So what did we see this past proxy season so far? And we call this a proxy season because we have not had an off season in the past decade. Historically, proxy season was a first half of the year concept where most companies were holding their annual meetings in the May-June timeframe. And then activists really didn't start surfacing with public or private campaigns really until the end of the calendar year leading into the following proxy season. But increasingly every year, we're seeing so many campaigns percolate privately and then publicly in the back half of the year. And there just really hasn't been an off season. So what we did see through the first 3 quarters of this year heading into the fourth quarter was an increase in campaigns year over year. It looks like 2025 is expected to be a record year for public shareholder activism campaigns. Every year we say we think this is the year that the tide has been hit. We're not going to have an increase in campaigns in the coming year. but we get surprised every single year. I think part of that is because there are more public companies every year, but activists are finding ways to publicly and privately agitate more and more each year, and there's always a new mix of elements in the market that create a fertile ground for activism. And this year it started with Liberation Day, um, which caused a lot of companies' market caps and stock prices to drop dramatically. It resulted in an initial pause in activism while activists were figuring out whether or not they still wanted to be invested in public companies, and then wanted to run campaigns against those companies. But after that pause, as companies began to recover from the Liberation Day sell-off, we saw an uptick in campaigns after the stocks dropped and different industries got affected pretty badly. Again, as usual, most shareholder activism campaigns do get resolved. Sometimes they get resolved through settlements. Sometimes they get resolved through handshake deals. Sometimes the activist just decides to go away. But oftentimes, when they're resolved, it's through board change. And what we'll get into a little bit later is board change deals are happening more, we think, because the more sophisticated activists are finding better candidates than they ever had before, going into their networks, going into the director search networks through recruiting firms, and oftentimes finding candidates that are already in the company's pipeline, and it creates a fertile ground for a basis to resolve these matters. We're also seeing an uptick in M&A focused activism. Activists historically the past several years had not been pushing for as much M&A because the capital markets and the financing markets had been pretty dry. As that began to pick up in the back half of the year, we saw more pushes for companies to get sold. But then another interesting phenomenon that we have been seeing, and this is a result of the sell-off after Liberation Day, is companies that decided to run sale processes after Liberation Day, when their stocks got hit pretty badly, they're dealing with opposition to announced M&A deals because the activists think that the premiums that were commanded in those deals were not significant enough. So we're seeing an uptick in deals opposed, in deals getting voted down, and activism around that as well. In terms of the industries that have been getting hit, most notably healthcare, tech, industrials, real estate, hospitality, restaurant, food. I've pretty much covered the whole market because of the sell-off, but we've been seeing a lot of activity in that space. And then most recently, since the summer, there has been an activist, Holdco Asset Management, that has been targeting the community banking sector pretty aggressively, issuing a presentation this morning, actually, about the sale of Comerica to Fifth Third, which it's an interesting campaign that launched this morning because the activist had been pushing for Comerica to be sold, and it got sold. And now the same activist is, some might say, looking a gift horse in the mouth, and opposing the sale, saying the premium is not enough. So we'll be watching how that one unfolds. Patrick, did you want to add anything on this slide before I move?
No, we can move on.
And just a question from the audience. Paula asks, so we're seeing tech companies stay private for much longer. Do you think the desire to be shielded from activists is a consideration here?
Lawrence, you mind if I take that?
Go ahead. It's all you.
So I think that's more of a feature of a deepening in private credit, both in the sort of seed round all the way through to several deeper rounds in ways that historically didn't really happen before. And you now have a deeper secondary market for private capital, right? So that, there are ways of incentivizing employees without having to go public in ways that historically weren't the case, right? So I think it's more of a factor of that. I do think that the entire regulatory system around being a public company is something that many private founders and members of private boards would rather avoid. And part of a consequence of being a public company and having to report on a quarterly basis is that you, in all likelihood, will have to deal with activism. And so I think it's part and parcel of the consideration, but I don't think it's really what is driving um, companies staying private for far longer and raising far more capital than we saw, 20, 25 years ago.
So
Go ahead,
as I
Alex.
mentioned, as I mentioned earlier, a lot of these campaigns are getting resolved through formal agreements or informal handshake agreements or walkaways by the activists because of the quality of the candidates that activists are identifying. Historically, going back, let's say 10, 15 years ago, even the more sophisticated and well capitalized activist hedge funds were nominating principals to boards and nominating folks that were coming out of a similar activist Rolodex. That is not the case anymore for especially the companies in the larger market cap space, industry agnostic. When sophisticated activists are putting slates together, we're finding that those slates are usually more thoughtful than they were approximately a decade ago, and more sophisticated each year. And as I mentioned, oftentimes when we're working with boards and management teams, we're seeing candidates show up from the activist Rolodex now that were already in the company's pipeline. And sometimes there are folks that the company thought would be a good add to the board, but they hadn't been able to get out to them yet. So that has caused a lot of earlier on settlements in these situations. There are other atmospherics too. Of course, when there was a sell-off in the market earlier this year, there were some companies that decided to hunker down and settle quickly with an activist so they can get back to business and focusing on addressing the fallout from the market sell-off. And those resulted in a lot of settlements, but easier to get to that finish line with an activist when the quality of the candidates are better and more qualified and well-rounded. We're also seeing, and I know this is an issue that Patrick likes to speak about often, we're seeing, especially in the larger companies, activists staying under 5%, which means they do not need to publicly disclose their ownership on a Schedule 13D with the SEC. We're seeing a lot of private nominations, no press releases, no public escalation, no rumors being put out into the market, and the activists using that as a tool to try to get enhancements to boards without going through the whole public process about it. And Patrick, do you want to talk about that a little bit?
Yeah. So historically, activists viewed the submission of nominations to contest a company's slated upcoming annual meeting as sort of a burning of the boats on the shore. And now you must go public and you must sort of see things almost all the way through or get something, quote unquote, right? So it was seen as sort of a crossing of the Rubicon and a point at which you almost certainly were going to make those nominations public, even if you were not a 13D filer. So you had no obligation to make those nominations public. We've seen a slight pivot from that. And that slight pivot is activists now, particularly activists that are under 5% and are not 13D filers, submitting nominations as just a way to retain optionality to potentially do something at the annual meeting, maybe. And what that has meant is that the road of private constructive engagement has creeped out a little bit further. It's a little bit longer now, and you are able to sort of navigate the demands of an activist privately throughout a longer period than before. But it also means that activists are being more aggressive in terms of trying to manage their leverage as long as they possibly can, and are willing to negotiate longer, harder, as opposed to, let's settle early, let's settle quickly and get what we can. Activists are now submitting nominations and saying that we are going to maximize whatever the value of our negotiations can be, even if that means we have to spend, $15,000, $20,000 to figure out a way to paper a nomination notice and or source potential candidates and keep it all private in the background.
We're not a huge fan of settlement agreements to resolve activism campaigns. Oftentimes some of the best results that we can navigate to are ones where there's a mutual walk away or there's a handshake understanding that certain changes will be made within a certain time period. We find that settlement agreements oftentimes they don't last long enough, even though they may last for an annual meeting cycle, they typically peel away. Most settlement agreements do, several months in advance of the next annual meeting. So it really provides an ecosystem for, 7 to 9 months of a peace treaty, which usually isn't enough time for a company that's been the target of activism to execute on a plan. When we are able to get to settlement agreements, we try to get ones that are longer. We've had some success doing that. We find that 2 annual meeting cycles are longer. Generally will provide runway for a company to execute. So when we do try to resolve things involving director changes formally, we try to get longer agreements, although the market for these agreements is 1 annual meeting. I think there's another question.
Yeah. So Christian asked sort of, and I think you'll get to this, but sort of the outcome of activist campaigns, proxy fights, settlements agreements, sort of what's the landscape there?
Patrick, you want to take that?
Sure. So we are seeing more settlements than historically we have in the past. Activists are still very much focused on resolutions that involve board change if the campaign has reached a point in which it's now public. We've seen CEOs be increasingly targeted as part of activism campaigns. That is in all likelihood due to the main thesis historically for activists being, sell the company, sell this thing, or break it apart and sell it. That thesis not having a macro climate that could be acceptable for selling a company, right? So we were in a higher interest rate environment for quite some time. So activists pivoted their criticisms to, well, don't sell this thing because there are no buyers and financing would be difficult, to let's focus on operational changes. And who should we target if we are going to focus on operational changes? CEOs. So we've seen activists target CEOs more frequently. Obviously, that means that settlement for an activist, once you've targeted a CEO publicly or even privately for that matter, are more difficult because in all likelihood, the company is not just going to summarily terminate its CEO just because an activist demanded it. So you have board compositional changes in lieu of that activist demand of a CEO change, and we've seen that more frequently. But yes, we've seen an increase in settlements. We've seen an increase of settlements that sometimes are happening earlier in the cycle. Part and parcel of that is probably the universal proxy card and it now allowing a more targeted, focused means of pinpointing directors from an activist perspective, which has led a lot of boards to really get religion on how deeply they want to get into a campaign and whether an activist really is going to have that much of a difficulty targeting one director and moving one director in the era of a universal proxy card. We've seen that difficulty has slightly decreased from the prior to UPC days. So that's sort of the macro environment climate. Go ahead, Lance.
We've all seen in the past 2 proxy seasons, most notably, an uptick in withhold the vote or vote no campaigns. On the next slide here, we list a few of them. I'll note that the one on top here, Cracker Barrel, is still ongoing. It goes to a vote in several days. And Cracker Barrel is an interesting example because the activist there, I believe, has run 8 proxy fights against the company, losing, I believe, 6 of them, settling 1 of them for a mutually agreed independent director. And this year, the activist Biglari sold the majority of its stake in the company, but believed that the company did not handle a rebrand of its logo and its brand properly, and believed that the company over-rotated on certain ESG related issues at the board level and in the company, and value had not been created adequately according to the activists. So there's now a withhold campaign being run against one director that has an ESG type background, and also against the CEO of the company. ISS and Glass Lewis have both come out in support of the activist campaign there. I believe Glass Lewis supported withholding on the 2 directors. ISS supported on withholding on the 1, which goes to show that ISS and Glass Lewis do look at these proxy fights on a case-by-case basis. They clearly, at least in the case of Cracker Barrel, did not hold the past unsuccessful proxy fights against the activist. ISS's contested research team that wrote the report is under new leadership this year, and that could have played a part in that recommendation. So we're watching how that one plays out. But the interesting thing about withhold campaigns is that obviously the activist doesn't need to nominate directors. They just try to cause the removal of directors from the board by them not getting sufficient votes. And even where the activist doesn't get enough votes to cause the removal or the resignation of a director, if the activist can get north of 18, 19% against any particular director, it sends a message to the board and to the management team and to the rest of shareholders that there's traction. And it puts the company in a situation right after their annual meeting where they have to begin thinking about how they're going to process that feedback leading into the next proxy season. There were a number of other withhold campaigns this year with varied success, but most of them did result ultimately in board changes. There is a playbook for getting through a withhold campaign should you find yourself in one. And there are different types of withhold campaigns. Some of them can come out of nowhere, informally, just a few weeks before an annual meeting. So a board needs to be prepared, even if the shareholder hasn't nominated alternate directors for a proxy fight. A board needs to be prepared. And of course, in the case of Biglari against Cracker Barrel, Biglari actually filed a proxy statement and collected proxies against the reelection of 2 directors, which was a formal campaign. And it plays out very much like a regular proxy fight for board seats. And it takes up a lot of the board's time and bandwidth, and requires a lot of preparation and planning in order to successfully navigate through.
Just one thing I'd add to that before we move on. One of the key distinctions between a withhold campaign and a traditional proxy contest for board seats is the lack of notice that a company can receive if it's subject to a withhold campaign. So traditionally, if you are in a proxy contest for board seats, the activist would have had to submit a nomination notice that is consistent with the timing that is required for nomination notices to be delivered under that specific company's bylaws. Usually a nomination notice must be delivered between 90 and 120 days prior to the anniversary of the previous year's annual meeting. And if it is around that sort of cycle, that timeline, then a company has significant notice to know that it will potentially be in a proxy contest at that next year's annual meeting. With withhold campaigns, that is not the case. You can receive no notice at all. right? You can be in a position where you've already filed your definitive proxy for that year's annual meeting. And 2 days later, an activist files a proxy of its own to contest a few directors vis-a-vis withhold. And there was no notice, there was no inbound, there was nothing, right? So it can really be a situation where if there hasn't been enough pre-work, just in case an activist does show up with a withhold fight, that you could be caught flat-footed on your back foot in terms of responding to and dealing with a withhold campaign that had no notice attached to it. But go ahead, Lawrence.
Patrick, you want to cover the targeting of CEOs, which we saw a lot of this past proxy season?
Sure. Yep. And I spoke a little bit about this a few moments ago. The context for this is in 2024, there were more CEOs targeted globally by activists than ever before. And in addition to that, we saw more turnover at the S&P 500 level of CEOs than we had seen in 30 or 40 years. So we are at a weird point in time in history when there has been an increased amount of focus around CEOs, around succession planning in connection with next CEOs, and everything that is sort of related to that. Activists have targeted CEOs more frequently, as I mentioned before, as a means of trying to unlock some value in lieu of actually trying to get companies sold. So there has been a far more focused effort around operational changes, operational criticism by activists, and far less of a focus on just getting companies sold because of market dynamics, as I mentioned earlier. And that's resulted in a lot of CEO turnover. What activists understand, and this is one of the reasons that when targeting a CEO, many activists choose to run a withhold campaign as opposed to a traditional proxy contest to remove and replace the CEO on the board with someone else, is that from a proxy advisor's perspective, there is a higher burden of proof to get the ISS Glass Lewis recommendation for an activist that has targeted a CEO. So for those who don't know, the minority slate change test for ISS and Glass Lewis is two-pronged. The first prong is there a case for change? That case for change is based on an operational and financial analysis by each respective proxy advisor, TSR over 135, CAGR analysis, multiple analysis, et cetera, along with a governance analysis. If a case can be made that change needs to be affected at the company based on the first prong, then the second prong that the proxy advisors move on to is who is in a better position to affect said change, the activist's slate or nominee, or the company's incumbent slate and or nominee. After getting through the first couple of cycles in the last few years, what we found is that ISS, Glass Lewis, they are using a sort of mid test that's a little bit higher than their usual short slate test, but lower than their control test when CEOs are targeted. And they've worded it as effective control in their recommendations. So if you are targeting a CEO and you're an activist, you have to provide a succession plan in case the actual CEO resigns after he or she has been removed and replaced on the board. You have to have almost a full 100-day plan as to what will happen after your person joins the board and the CEO is no longer on the board and potentially resigns. And you have to show pretty strong underperformance on a 135 basis. So it's a very different test than your usual short slate test. And activists are not keen to embrace that test because it is more difficult. Lawrence, we go on the next slide.
And the other thing I would add before the next slide is it used to be unusual for an activist to target CEOs, particularly early on in their tenure. But we're finding that new CEOs are not getting as much runway as they used to get before they draw the ire of an activist. It could happen as soon as after the first quarter, particularly with first-time public company CEOs. And, the new 13F filings were just made by investors. They just came out on Friday. We were scanning them all weekend to see which companies have new activist positions or increased activist positions. And there are a number of companies that have had very recent CEO changes the last quarter or two that now have activists in the stock. They view it as an opportunity to either ride the stock up because there was a CEO replacement because the stock had dropped and the company maybe had not been performing well, or they're viewing it as an opportunity to be a part of the ongoing changes that are being made. They're watching these situations very carefully.
Lawrence Patrick, question about sort of the executive actions being considered to sort of targeted towards proxy advisors. Any thoughts or how you're viewing that?
I'll take.
Go ahead.
Go ahead, Lawrence. No. So I think it's still in early stages. It's still in early days. This moment in history is not the first time that ISS Glass Lewis have been under the microscope and have dealt with threats of being regulated in a pretty strict and harsh way. So it's not new from that perspective. It's not clear yet whether or not the EO will actually happen. I think that what we expect from the proxy advisors is probably a more moderation in many of their recommendations as to not draw too much attention to themselves during this period of focus, because they know that every little thing they do right now is going to be under a microscope and really scrutinized. So we expect maybe a pivot, probably a pivot away from being as open to activists' arguments in their recommendations. We don't know yet. If there actually does seem to be a tonal change that comes out of ISS and Glass Lewis in their recommendations, that could also be because of the leadership change, for example, at ISS that Lawrence mentioned earlier. So it's still a little bit early, but we do anticipate some changes in terms of the tone and tenor of ISS and Glass Lewis recommendations.
Patrick, social media?
Sure. So over the last few years, we've seen both social activists and professional shareholder activists lean more into social media as a means of amplifying their campaigns, as opposed to more old, tried and true press releases and trying to get on television to amplify a campaign. We've seen far more leveraging of social media. Part of that may just be a change in vintage of many activists. We are now in sort of second or third wave activism. So we have now younger shareholder activists, younger social activists that grew up on social media, right? And as a consequence of that, they use social media in a much more aggressive way. And companies are now having to respond to social media campaigns in a way that they didn't 10, 15 years ago. So we saw in 2024, many companies, Deere & Company, for example, Harley Davidson, Lowe's, pivot away from their previous DEI institutional policies and lean more into sort of neutral DEI and or doing away with DEI altogether as part of their corporate governance policies in reaction to social media activist Robbie Starbuck, who gathered quite a large audience and was able to amplify that audience and cause some companies to actually change their ESG and DEI policies. We also have seen more traditional economic shareholder activists use social media as a means of sort of A/B testing various campaigns. So you put out a thesis, you put out a different thesis, and you see which one gathers the most steam and results in the most engagement. And then that's the company that you focus on in terms of actually trying a more formal shareholder activism campaign. That's sort of been a means of activists being able to wrap their arms around not just what companies to focus on, but costs for amplification of their message as well. And it's been pretty effective from an activist perspective. It's a lot cheaper to put out a tweet than it is to actually file a press release. So we anticipate that activists will be utilizing social media more in the future, and companies are going to have to be far more vigilant than they were in the past to social media engagement, social media campaigns that may seem like rumbles, but end up being sort of tidal waves, and being able to react to those campaigns at a much more early stage.
Totally agree with that, but let's also not forget that the white paper could still be made public, the press release, the mailing, the email, all of those tools are still available and they're widely proliferated. We actually saw in the Cracker Barrel campaign from Big Laurie, which we've been watching from the sidelines, the use of billboards by the activist in the town where the company is headquartered, and when some of the executives live, which is one of the earlier social media tools, the billboard. We're also seeing, notably with one activist right now, Jana Partners, but we've seen it with Starboard in the past, the use of celebrities as part of shareholder activism campaigns. It also ties in with the social media point. We saw Travis Kelce lend his name and his love of Six Flags to Jana Partners' recently announced campaign. When that campaign was announced during the middle of the trading day several weeks ago, the stock popped 18%. Kelce has signed on to that campaign. He's not a candidate for the board, at least right now, but has indicated an interest in endorsing the company and working with it to reimagine the offering for another generation. We've also seen other athletes like Shaq get involved in Papa John's, serving on the board, becoming a franchisee, lending his name to product offerings. The jury's out on whether that was a successful value creation tool over the long term, but it was a tool to drive Papa John's to a resolution with Starboard several years ago. We'll see what happens with Six Flags. Advance notice bylaws. I'll give my 2 cents on this and then hand it over to Patrick. In most public companies are incorporated in Delaware, and there's usually in a company's bylaws a window of time that Patrick mentioned earlier. It's a 30-day window of time, about 3 to 4 months before a company's annual meeting. It's called an advance notice window, and a company's bylaws state if you want to nominate directors for a proxy contest, you need to make your nomination during that window. And the bylaws set forth a tremendous amount of information, usually, that an activist needs to provide about its nomination thesis and its candidates in order to have validly and timely submitted a notice. Our view of these bylaws are they can be very useful information gathering tools for companies, and of course, the rules for these bylaws apply equally to all shareholders. And sometimes there's a basis to invalidate nominations under carefully worded bylaws. We have found, though, that it is not the best strategy to only rely on your bylaws to win a proxy fight. We have found that usually winning a proxy fight by winning the democratic election of your candidates by a wide margin results in a much better long-term result for a company than relying on the bylaws as a means to invalidate nominations and make the activist come back for the next year. Because usually, eventually, an activist will figure out how to comply with your bylaws. And if a company relies on the bylaws in year one to get out of a proxy fight, which happens sometimes, we have to do it sometimes. Oftentimes it is the case that the activist will come back the next year, comply with the bylaws, and in the intermediate time frame, the company hasn't performed well. and they're now more vulnerable in year two than they were in year one. There have been some developments in the legal landscape coming out of Delaware. Maybe Patrick could touch upon those for a second.
Sure, well, but I think we have some questions.
Oh, we
It
do.
looks like we have.
Yeah, so a couple I'll give to you. So just sort of SEC exploring semi-annual reporting schedules and what would the implications be for activists and clients if we went that direction. And then I'll give you another. Any comment on ExxonMobil's new retail shareholder proxy voting program? Do you think this could help management teams garner enough votes, or more likely just to be one of many tools a company could use?
Okay, so I'll take the first one, Lawrence. Please chime in, and you can take the second one. So, in terms of the changing of the reporting cycle, I think from an activist perspective, the consequence will be that activists are going to have a lot more trust and faith in management and in the company and in operations, because they are not going to have access, at least not on the same timeline, to information and data that they would have under your traditional cycle that we have now. And that may cause tensions because the majority of the activism business, where the breakdown actually happens, is trust and faith. And if an activist is in a situation where it has to deal with a longer period of darkness, where it's not going to know how a company has performed, it will probably be more likely to be aggressive, more likely to submit nominations, for example, and less likely to just go on faith and belief that everything's going to be okay. And once the quarter is, or not whole quarter, the half, I guess, actually get released, the activists will be very pleased with results. They're probably going to take the position, no, we're going to handicap that to 50-50 at best, which means there's a 50% chance that whatever comes out at the half, I'm going to be very angry with and wish in hindsight that I had been more aggressive and probably tried to position myself to run a campaign much earlier in the public. So from an activist perspective, less information is not a place they want to be. They always want more information. And if they aren't going to have it, they're going to probably agitate publicly more.
Yeah. Thanks.
Lawrence, you want to take the...
Sure. But, generally, when folks are used to getting information from public companies, financial information several times a year, like clockwork, when that is pared back, you could see the ground for agitation come up just due to the uncertainty of what's happening during the intervening periods of disclosure. I think it would create more grounds for activism, except for less grounds. Although I probably could make the argument that if there was monthly reporting, we would have exactly the same result. More activists agitating because there's now more information out there in the market. In terms of Exxon's retail voting program, number one, I'll say that it was very well timed, right before the government shut down, and had it waited another month and a half, who knows if it would even been rolled out this year. So kudos on the timing, and can imagine the amount of work that went into the SEC's no action relief issuance on that. Probably had been going on for years, if not months. The program does seem like it would be a very effective tool for large companies with very significant retail shareholder components. They'd be able to give standing voting instructions through a proxy voting utility called Broadridge, which is the largest voting tabulator in the world. Process votes for contested and uncontested annual meetings. So the concept is innovative. The technology is still being developed. And the SEC has said they're not going to intervene with this for now. For a lot of our clients that have been reaching out asking what to do. We're we've been watching the developments very closely. Our view is, let's see how this product unfurls during the next proxy season. Uh, uh, we imagine that it will be, successful in terms of, driving out more retail shareholders to vote in support of board recommendations. And we'll see how the technology develops. The technology will, I'm sure, be more advanced in 2027 than in 2026. And I think a lot of companies that we're talking to, that others are talking to, are starting to make preparations now to be ready to try to implement something like this in the 2027 proxy season. It takes a lot of planning. Again, probably more helpful for companies with very significant retail shareholder components. We're also going to be watching closely the cost associated with setting up and implementing the program. But it definitely is a means for expanding shareholder engagement. The SEC is rightfully all over that. And in fact, when we're involved in proxy contests, this doesn't necessarily apply to proxy contests, but one of the biggest challenges is getting the retail shareholders out and voting, and perhaps through encouraging them in uncontested situations, which is what Exxon is doing here, to come out and vote. It'll be easier to get them to come out and vote in the contested situations. So if you ever find yourself in one.
Great.
Do we have
And
another question?
yeah, one more while we're here. So, question about sort of use of lenders in the activism context, especially given the growth of private credit lending. What are you seeing?
I guess I want to know kind of what is meant by that question. Are activists receiving private credit to run campaigns, or?
That's how I read it.
Okay, so have not seen many activists, particularly activists that are 13D filers that have gone over 5% and have to disclose out to the market how they financed their positions, turn to private credit to do so because they would have had to out that. And we haven't seen that on a sort of fulsome, robust basis. What we have seen are activists that set up special purpose vehicles to go after a very specific company, as opposed to subjecting a company to activism based on sort of the activist's sort of larger fund, right? So you set up the side vehicle, you have investors who are only interested in your campaign for that targeted company, and that's all the exposure they want. So we've seen a lot more of that. Now, by a lot, I want to qualify that because it isn't something we see super frequently, but it's definitely something we see more frequently than private credit being the leverage that activists are using to finance their campaigns, for sure. Are there any more questions? Or
And I just want to be mindful of the time. I think Lawrence and Patrick, you might be able to go a bit over. We had a late start. For folks that have a hard stop at the hour, we're recording this session, will be made available to participants as well as the slides. So for those that need to leave, just keep an eye on your email. And if you are seeking CLE, check the chat for the link to provide your information to receive that. So I'll turn it back over to you guys.
Thank you. So we always have thoughts on advanced preparation. We get a lot of questions on, what should we be doing now to prepare for the day that an activist may show up and, target one of your companies. So we've listed a number of these advanced prep items on the following slides, which we'll run through. So, first and foremost, we call it financial self-evaluation. Be your own activist. Ask the tough questions of management. Ask the tough questions of yourselves, and then cross-examine the answers to those questions. That's part of satisfying your duty of care and your duty of loyalty as fiduciaries. Oftentimes companies get caught flat-footed by an activist letter or an activist white paper, or a hostile call from an activist between earnings cycles. And we will get the phone calls during that time to help put out the fires. And what we find is there's often, for lack of a better term, a lot of emotion that goes into receiving oftentimes a hyperbolic letter or presentation from an activist. We find that the boards and management teams that sit down and write the activist letter themselves with their advisors, or at least bullet out the activist's potential arguments and rehearsing the rebuttals, are best situated to respond in a way that is best for all shareholders and consistent with the plan that the company's executing on. So doing that in peacetime is something we're seeing many more boards and management teams doing now, and there are a range of examples for tabletop exercises. We're also recommending in peacetime, looking at the company's corporate governance and structural defenses through the lens of, if we found ourselves in an activism situation, what corporate governance tweaks will we wish we would have done in advance so that an activist couldn't take credit and wouldn't look reactive. Likewise, with structural defenses, we talked about bylaws earlier. What do you want your bylaws to say in terms of an activist's disclosures about loans that they've taken out to buy your stock, or their relationship with nominees that they're nominating? It's too late to put in those provisions in your bylaws after an activist shows up. So we recommend conducting those assessments on a clear day, so that, again, it's not reactive and the board doesn't get underwater by implementing changes after an activist shows up. For highly regulated industries, insurance, banking, life sciences, most notably energy utilities, important to maintain close relationships with your regulators. There are some state and federal regulatory regimes in highly regulated industries that require activists to go through extra hurdles in order to nominate directors, or to run a campaign for control, or to demand a sale. It's important to understand what those regulations are in peacetime so that you know how to activate them if you're facing a threat. And likewise, good to know who are the regulators to contact when these issues come up so that you're not scrambling. On the investor relations front, boards have access to so much data that gives you insight into what your shareholders are thinking about you. You get your annual meeting results. Every year you have an annual meeting. You get voting data. It's important to analyze the data and undergo an archaeological dig for any votes, even 1%, less than 1%, against any director, against any proposal. Take the time, understand why the vote went the way it did. Go on the road, talk to your shareholders before your annual meeting cycle. Build a rapport with them. If you end up in a proxy fight, you won't be interviewing with those folks about your board seats for the first time. It's great to create that runway. You also get ISS and Glass Lewis feedback for now, pending government influence over that. But you get that feedback, and important to process that feedback as well. Patrick, do you want to talk about how shareholder data can let a board know whether an activist is lurking?
Sure. So one of the best means of knowing if an activist is in your shareholder base is monitoring your shareholder base. So stock surveillance. Many companies believe they have stock surveillance because they're using sort of an off-the-shelf type of product, as opposed to working with their proxy solicitor to have their proxy solicitor do a real deep dive as to who's in the shareholder base. and find that in hindsight, they probably should have been working with their proxy solicitor. Figuring out who's in your shareholder base, who's hiding behind what are called anchor custodians. So your brokerage houses, Nomura, UBS, Goldman, figuring out if there are buildups in any of those shops and whether or not it's due to an activist, more art than science. So having a proxy solicitor that has experience in figuring all that stuff out and being able to give you its best guess or estimate as to whether an activist is actually there based on its experience in the space is far more useful than an off-the-shelf product that can just tell you, there's a broker bill up here, there's a broker bill up there, but can't really give you any insight into why the brokers are sort of having their buildups where they are, right? Which activists usually use UBS? Which activists usually use Nomura? Is this a situation where you have an activist that is probably using derivatives, right, to gain economic exposure, and then the anchor custodians are facilitating that by hedging the counterparty exposure there? Proxy solicitors can give you a lot of that data. We have found that recently, over the last 5 to 6 years, so maybe not all that recently, but semi-recently, activists are far more frequently utilizing derivatives as opposed to just common to gain their initial exposure to companies, and monitoring your shareholder base to figure out the counterparty risk there is the best way to figure out if an activist is there early in an era where activists are using derivatives far more frequently. So that's sort of the chief means, monitoring the shareholder base. Obviously, you're going to want to make sure that if there is a Schedule 13D filed, you immediately receive a note there, a ping from either your proxy solicitor, your legal team, et cetera. Just make sure you actually have those alerts set up. You don't want to be caught flat-footed there. If you are a company that is on the larger side, in which, if an activist wanted to take a position of 5%, it would have to first cross over 126.4 million. Then in all likelihood, you're going to receive an HSR notification first. An HSR notification is just an FTC DOJ notification that an activist would have to deliver to both the company and the regulators and let them know it intends to cross over the $126.4 million marker to gain exposure to a company. That 126.4 million marker, that threshold benchmark, it's changed every year. So next year will be higher, right after February, January-ish. But you'll usually receive an inbound there if an activist wants to cross over that threshold. We have found that many of those inbounds have been going to spam and going to all sorts of different folders as opposed to just the GC or IR's traditional email accounts. So you're going to want to make sure you're changing and checking your spam filters so that you don't miss anything like that, because you don't want to be caught on your back foot in terms of an activist trying to gain that large of a position in your company. And from a technical perspective, all of it can remain private. So if there's an activist that may want to make that public, you certainly want to be informed privately before the activist chooses to do so. Those are a few of the sort of key ways of figuring out who's in your base. The most important thing we tell clients to do leading into the opening of their nomination notice period that was described by Lawrence earlier is to make sure you are checking your registered shareholders list to see if an activist has moved its shares into record name. That is the leading indicator that the activist will choose to run a fight at that upcoming year's annual meeting. 95% of companies have in their bylaws that in order to submit nominations, a shareholder must be in record form or be a record shareholder, which means you have to appear on the company's registered shareholders list in order to submit that nomination, have it be qualifying and or timely if you submit it during the window. So leading into your nomination window cycle, usually 2 to 3 weeks before your nomination window opens is a sweet spot for activists to move their shares into record name. It'd probably be between 100 and 1,000 shares. You want to be vigilant in terms of refreshing that registered shareholders list every few weeks leading into the opening of your nomination notice and making sure you are staying on top of it because it's the leading indicator that you might be in a fight for that year. Lawrence?
Some other advanced prep items on this final slide. around communications, assembling an advisor team in peacetime so you know who you're working with to navigate through one of these situations. And we mentioned a boot camp or a tabletop for the board and management. The last slide here, and then I think we're done, is a list of common questions we get during an activism situation around maintaining confidentiality, how to best create a communications ecosystem so that folks are speaking with one voice, preserving privilege, emails and text. We get questions about stock trading, et cetera. Those are all summarized on this slide. And as was mentioned earlier, this deck will be sent around, and feel free to use this as a reference point should you ever need it in the future. I think that's all we have.
Great. Well, it looks like thanks for putting up your contact information. Have a few minutes for some final questions?
Sure.
Okay. So, in your opinion, what have been the most successful and least successful? I think you mentioned the ESG context, but pro-human rights or pro-ESG campaigns this past year in the current geopolitical context? I guess defines how you, but go ahead. I'll let you.
Well, we saw a pretty large decrease in the number of 14A8 proposals that were submitted for ESG purposes. I think that obviously is a reaction to the climate. I have not seen an activist launch a sort of single themed professional campaign under the guise of ESG or DEI, except for a couple of years ago now, maybe last year, Starbucks. 2 years ago now, I think Starbucks experienced a campaign that was led by a labor union, where the labor union was sort of the first of its kind in actually launching a full-fledged proxy contest at a company under the guise of ESG, but ESG/labor, right? That campaign did not go all the way. The labor union ended up rescinding its nominations and settling for a letter with, a few choice and strong words from Starbucks about how it felt about labor and how much it prioritizes it. And that was sort of the end of it. What was interesting about that is that after, in the wake of that campaign, Elliot surfaced at Starbucks, and ba-bum, 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 Starbucks ended up having a CEO change. Starbucks had its chair at that time go from being its chair to its lead independent director. There was significant change in the Elliott campaign, and the thinking in our space is part and parcel of that change and how quickly it happened, and it not actually resulting in a company having sort of a real thorough fight in the public to combat Elliott, was because the company had just been through the prior year an activist situation with the labor union, and really at that point was trying to put activism behind it. So we have not seen a great deal of success. We don't anticipate in this climate seeing professional activists lean into ESG or DEI. What we've also seen are activists who used to be very full-throated in their support for ESG and DEI as a bolt-on thesis to all of their economic campaigns. All of those have fallen away. Activists are no longer even really mentioning ESG or DEI in the way they used to. So it probably shows you how committed they were or weren't originally to this as a concept. And it was more about leveraging their campaigns and appeasing institutional shareholders and proxy advisors. So yeah, we don't anticipate seeing a lot of it in the future.
Okay. Two more, and then for folks that can't stay, thank you so much for joining us. We will follow up with the email that you registered for this webinar with the materials from the webinar. Again, if you're seeking CLE credit, make sure you click on the link in the chat. Also, please find information about Stanford Directors College 2026. But for those that can't stay for these last two questions, thank you for joining us. So next question, Jenna asked, can you speak to any noteworthy case studies involving companies with European headquarters or largely international ops or investor bases? Are there any notable differences in the activist strategy for these sort of cross-border governance regimes versus one with a predominantly U.S. governance and investor profile?
Lawrence, I know you have some great thoughts on this. We've spoken about it privately.
It's
You want to take?
yeah. Unfortunately, the lawyer answer to it is it depends. Um, it really depends on where the company is incorporated, and what the rules are, in that country of incorporation. Um, there are some countries where it is a lot easier for an activist to get a nominee's name on a proxy statement. Um, uh, Sometimes there are just no barriers available, um, for an activist to be able to do that. And then it becomes about the campaign, and about the Democratic election. Um, uh, for for companies that are incorporated outside of the U.S. but have securities listed in the U.S., that are domestic issuers, so they file 8Ks, and have to file proxy statements as well, and they're subject to the SEC's proxy rules. Those campaigns are run a lot like the regular U.S. incorporated campaigns are. Um, uh, for foreign private issuers, that are not subject to the U.S. proxy rules, those fights can become very localized, and require a cross-border team, of usually folks from U.S. activism, defense practices at law firms and investment banks and at PR firms that understand the playbook, but also leveraging local counsel in those jurisdictions to understand the rules of the road on the ground. And depending on the geographic location and where the company is incorporated overseas, there could be very unique shareholder bases too. For companies that are foreign private issuers, their shareholder bases do not look as Vanguard, BlackRock, State Street, Fidelity heavy, as the more U.S. centric companies are, and those campaigns can be oftentimes decided by the more actively managed hedge funds and the retail component, and they become very intensive proxy solicitations. But again, it depends on the jurisdiction. We're seeing a lot more activism resulting in board seat success for activists in Asia, particularly. We're seeing it almost on a weekly basis now. We're reading about something in Japan, where historically it had been almost impossible for activists to get board seats or corporate reforms, but now we're reading about it regularly. I think as the U.S. activism playbook gets exported around the rest of the world, um, uh, we'll see activists the U.S. activists start to appear more in those jurisdictions, to try to pursue their objectives.
Okay, final question. So the conversation sort of started with advice on for boards not to settle too quickly, and so the question to can you expand on this, and then what are the items that boards need to consider when determining whether to settle or go through with a proxy fight?
Yeah, and I'll start, and Lawrence, please hop on. So the first thing is, what has the activist actually asked for? So activists are not in the profession of getting board seats. Like, that isn't going to make them money. And these are economic animals. They care about making money. And that's their sole objective, really. And if the company fails to do the operational and or sort of transactional things that the activist wants in the short term, then the activist will pivot towards, okay, let's get some people in the boardroom who can better champion my ideas, right? So if the activist asks, for example, for the company to be sold, that's a tough place to bargain. Right? Like, that's not going to allow you a lot of wiggle room in terms of trying to build a constructive framework around a resolution and an agreement, right? But if the activist has asked for changes in the alignment for executive compensation, or a reevaluation of what are or are not core assets, then that's a conversation that can be had and potentially result in board change, right? So it's never a good idea to just immediately say, yes, yes, sure, we'll do A, we'll do B, we'll do C. Inevitably, if you do that, the activist will all of a sudden come up with D all the way through Z, because there's a feeling that the company just doesn't want or doesn't have an appetite for public activism and will do anything to avoid it. So there is a really, sweet spot of being open-minded, but not just rolling over. And you have to maintain that sweet spot. Otherwise, you probably will do yourself more harm than good when it comes to avoiding a public campaign. Now, obviously, every company has its own red lines of things it absolutely will not negotiate on, and you have to stick with those red lines. The worst thing you can do is come out very aggressive, very combative, and then all of a sudden have a change in tone once the activist goes public, because now you are sort of seen as being a little bit of a paper tiger, and everything that you have said privately in the past is now thrown out the window because the activist knows you don't have gravel in your guts for a fight, right? So we usually see settlements happen a little bit earlier than they historically had. Over the last couple of years, we've seen a moving up of settlements. Much of that, as to what was mentioned earlier, is probably the result of being in the wake of the universal proxy card. But it depends, to Lawrence's point about it being the lawyerly answer, on what the activist actually wants the company to do operationally and or transactionally, and whether there's any wiggle room to negotiate within the parameters that the activist sort of has laid out.
These settlement agreements, if you get a formal one, the benefits to the company are a voting commitment, particularly if the activist owns a lot of stock, a standstill against buying more stock, and a prohibition on any form of public and private activism. That's the heart of the peace treaty. In exchange, the company will, commit to corporate governance or board reforms. And those need to be very carefully drafted. We like to see those agreements last for more than a year. We've had some success getting those for more than, one annual meeting cycle. But if it's going to be one annual meeting cycle and it's going to be a 9 to 10 month peace treaty, it needs to be negotiated very carefully. Very too often when we're watching on the sidelines, we see agreements inked and then an activist going off and talking to other shareholders or giving a solicited or unsolicited comment to the media, which almost immediately violates the spirit of the agreement. So they need to be very carefully drafted. And last thing, to Patrick's point, the board needs to always put together a settlement toolkit, identify what are the sleeves off the vest that the activist is seeking, that the board was doing anyway. And if you can architect a solution around that, great. If you can't and the activist turns it down, at least when you're talking to BlackRock and Vanguard and ISS and Glass Lewis, you could say you tried when you're in the middle of a fight and you're 2 weeks out from your annual meeting. That's a good talking point to have when you're lobbying for their endorsements and their votes before a contest.
The last thing I'd add to that is sometimes there's a feeling of, well, it's only one director that the activist has asked for. What the heck? That is not the mindset that a board should have. There should be a really thoughtful conversation about whether the individual that the activist is recommending, particularly if the activist is recommending him or herself, and how the addition would change board dynamics, and whether those changes in the boardroom in terms of the dynamics would be adverse to what the company is actually trying to achieve and the cohesion of the full board. So I think that's one of the leading things that you really have to think about. Board continuity is a real thing. Activists do change dynamics when they enter into boardrooms. Some have reputations for being grenade throwers and loving to sort of mix things up and being sort of the inside agitator on a more combative basis. And you have to consider all of those things when you are thinking about, should we actually just have a proxy contest, even if it's just for one seat, because the person that the activist has suggested is just not someone that we could accept on this board, even though it's just one body.
Well, Lawrence, Patrick, thank you for your time, and everyone, thank you again. This is a topic we'll cover at Directors College and in the interim with different voices from proxy advisors to prominent activists themselves. And this was a great way to kick off the conversation this year. We'll see you soon, and everyone have a great day.
Thank you.
Thank you.
Thanks again. Thanks, Lawrence. Thanks, Patrick.
Thank you.